Hi, everyone. I'm Michelle Yu, and welcome to A View from the Floor here at the New York Stock Exchange. And I'm joined by a very special guest, Tim Anderson, Managing Director at TJM Investments. Tim, thank you so much for joining us. It has been a tumultuous few days here at the New York Stock Exchange. After Liberation Day, the stock market has gone into whiplash. We seem to be seeing a little bit of a reprieve. What is your position on the market's reaction after Trump's tariffs policies?
Well, look, the markets were extremely oversold on a very short-term basis. Thursday and Friday, we had near back-to-back 90% down volume days. That has almost always been a short-term, very oversold indicator. And then, of course, we had very heavy volatility up and down yesterday. And in fact, one other technical indicator that I really love looking at is the new highs, new lows. And yesterday, the New York Stock Exchange had one stock make a new 52-week high and 1,160 make 52-week lows. So I think that's another indicator that we were just short-term, very, very oversold. We got a couple positive tidbits or news headlines, mini news headlines out of the administration on the talks they're going to be having with a lot of other countries about resolving tariff issues. And so we're having a reflex rally right now. So far it's holding. We're a little over an hour into the day. It'll be very, I think investors will be very focused on whether or not this market holds as this rally holds as the day goes on. We're up maybe 3%. We've got a lot more than that to make up. But you will also see people really focused on what sectors are the strongest on the first rebound, because the sectors that lag this move higher today are probably a good indication of what are really the weaker parts of the market.
Well, you talk about sectors. What areas of the market do you think or could be on the upside?
Well, look, the healthcare stocks got a big boost in after hours last night after you had this, what they call this CMS payment announcement from the Health and Human Services to Medicare Advantage firms that do Medicare Advantage. So that helped those stocks, and a couple of those stocks are very, very high-priced stocks, and the Dow is an arithmetic index, so that's helping the Dow a little. United Healthcare is helping the Dow quite a bit. We've got to watch those stocks because those stocks have been under quite a bit of pressure, especially with the angst that that industry is having with RFK Jr. being the head of HHS. But then the tech stocks have been hit really hard. They probably peaked out anywhere from last summer to late fall. And we're already in a downtrend before a lot of this really started to percolate late last week. So we got to see how much they bounce. And then anything that's related to consumer spending, because the big fear would be if you got a really bad wealth effect that lingered in the stock market for a while, that could impact consumer spending, and then we might have a recession.
We were talking earlier about how all of this is impacted by the sensitivity of the headlines. With that being said, how do you see the rest of 2025? What is the outlook, you think?
I just think we're going to have a lot of volatility. I mean, look, for 2023 and 2024, we had actually a fairly boring market where the averages were up to, from the low to mid 20s or a little bit better 2 years in a row, with maybe 1 or 2, 3% corrections along the way. And so we were already set up for a well-deserved pause or correction. Clearly, the headlines and the policy initiatives out of the administration have sparked a lot more than just a little bit of a correction. It's like a sharp, quick plunge, but sometimes that's good to get all that over with in a hurry rather than just have it be a drawn out, gradual decline that goes on for 6 or 8 months. So obviously we got to watch the headlines. The market's very headline sensitive. That's just, it always is, but that's exemplified with Trump as the president. And then we'll, look, earnings start this Friday. But companies are going to have a really hard time with guidance. You know, we always watch earnings and we always watch forward guidance. But what are companies going to say? I mean, they can't really. They have to kind of say, we're a little unsure with our guidance right now because we don't know where the tariff landscape is really going to play out. And the problem for the market is that creates uncertainty. And if the old saying is that the market loves good news, it can deal with bad news, but it hates uncertainty. Because CIOs and market strategists, they have models. And if you don't know what the tariff landscape's going to be yet, and where everything's going to settle out, it's going to settle out a lot better than it is right now, then you don't know what to put into your model. So it just leaves a wide range of variability open. So, you know, we're going to continue to look for guidance on tariffs, but we're not going to get definitive answers on that probably for a while.
So will this impact the Fed and how they look at rates next?
You know, the Fed, I think, does a pretty good job of trying to be independent. I know they'll always get criticisms from both the left and the right about being political. I think they do a pretty good job. Now, that being said, of course, they are following what's going on. Is it going to tip the scales one direction or the other? It kind of depends on what all the other data is that they're getting. Inflation's been fairly benign. It's been hovering right around 2.5. Not at the 2% that's their official goal, but certainly a lot better than it was for a good stretch of time between 20 and 24. And they are going to look really hard at whatever the final tariff numbers are, whether that causes a little bit of maybe a one-term price hike in some industries and some finished product goods, whether the manufacturers in the supply chain absorb a lot of that and don't pass it on to consumers. And then if any of just the chaos in the financial markets impacts consumer spending and sparks layoffs in any industries other than government employees.
All right. Well, Tim Anderson, I know it's a very busy, crazy time here at the New York Stock Exchange. Thank you so much for joining us here on Asset TV. And now do it for us here on the Stock Exchange. We'll see you next time. I'm Michelle Yu. Take care.